My name is Rick Blanke, Managing Partner of Blanke Schein Wealth Management, and welcome to the next installment of our Financial Foundation series. We're going to take a little bit of a break from topics like we've been discussing, like cryptocurrency and the metaverse, and we're going to discuss a real-time relevant topic of the Federal Open Market Committee, or FOMC, raising the federal funds rate. They just raised it 25 basis points, or 0.25%. And there's talk that they're going to continue to raise the Fed funds rate multiple times over the coming months. So what does that mean for you? We're going to discuss that coming up next. So what does raising interest rates mean? Well, the Fed funds rate is the rate at which banks lend money to other banks. And raising the Fed funds rate pushes up the price of money. So basically, borrowing money becomes more expensive, and raising the Fed funds rate actually affects everything from credit cards to corporate bonds to the yield on treasuries. Now, 25 basis points is actually pretty small. The concerning aspect is that the Federal Reserve is talking about raising multiple times over this year. Some say even as high as 11 times. General consensus says the next couple months, in May and June, at least, there are going to be 50 basis point hikes each month. So while 25 basis points is small, we do see that increasing fairly drastically over the next few months. As I just said, the Fed funds rate only impacts directly overnight lending between banks, but it does indirectly affect the prime rate. And it could push the prime rate up slightly, at least with the 25 basis point hike. And with an increase in the prime rate, that affects variable rate loans, which would affect the credit card interest rate payments. Another impact of rising interest rates is your savings accounts. They could start yielding more. Now, it's not going to be right away. A 25 basis point hike is basically nothing, so I wouldn't expect a big bump in your yield from your savings account overnight. But if they continue, if the FOMC continues to push these rate hikes over the coming months, and you see drastic, 7, 8, 9, 10 rate hikes over the next year, it's something to keep an eye out for. Your savings accounts could yield a little bit more, which is encouraging. Now we're going to shift focus to the stock market and discuss how rising rates impact individual companies. I do want to preface again by saying a 25 basis point is not going to have a dramatic effect on individual companies, but if the Federal Reserve continues to raise rates at the speed that they're talking about and discussing, this could become more relevant in the future. Now, again, for Financial Foundation purposes, we're just going to discuss the general theme and how, in general, rising rates affect individual companies. Now, the relationship between the federal funds rate and equity prices is not direct by any means. But higher rates does rein in borrowing and spending. And that's important because when rates are rising, it's more difficult for companies to borrow, which would slow the pace of hiring, of capital investment, of acquisitions and stock repurchases. In addition to that, in a way, it makes stocks less appealing for certain investors because it does raise rates on treasuries, for instance. Maybe you're yielding a little more for a fairly conservative investment like a treasury, like a T-bill or a T-note. So maybe people opt to buy the treasuries instead of buying individual stocks, which again, you're not having that buying pressure behind the stocks to raise the market up. So it does have an impact. Rising rates do have an impact on the stock market, but it's less direct and it's more of a roundabout way. The last point that I want to touch on briefly is how rising rates impacts the strength of the US dollar. Now, piggybacking off what I just previously said about treasuries becoming more attractive, that's important to know for the strength of the US dollar because as treasury yields rise, more money floods into buying those treasuries, which in turn strengthens the US dollar. Now, because currencies are relative to each other, a strong dollar tends to weaken other currencies of other nations. Now, In addition to that, it makes American exports more expensive, and it also makes imports a little bit cheaper. Now, I know the Federal Reserve raising interest rates is not the most exciting topic, but it is a necessary topic to understand when you're constructing a portfolio, especially given that we are in a rising interest rate environment right now, and it's going to affect the market as a whole. So there's plenty more to discuss, and we're always available. So if you're interested, please reach out to us. We'd love to discuss in more detail rate hikes and the impact that it has on the overall market. Thanks.